Hey there, Jordan. How are you? Welcome everyone to the today's webinar. Excited to have everyone on. Um, Jordan, can you hear me?
I can. It's not letting me share my video though.
Okay, I'll get you connected. As
Okay.
everyone is joining us, thank you so much for being here to our free webinars we do every month. And my name is Liz. I am the co-founder of the Investor Community. Really excited to be joined by Jordan. So excited about what you're going to be talking about today. So let me get you connected. As everyone is joining us in the chat box, we love to get women and everyone that's here connected and engaged. So if you can put in the chat box what your name is and what you are looking to get out of today's webinar. That would be amazing because then we will check in with everyone to see what you've gotten and how we could best support you moving forward. And I will help you, Jordan, here to see how we can make sure you can be seen here. I think you should have the ability now. Can you see now? Awesome. 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 Great to meet you, Jordan. Oh, now I can't hear you.
There we go. There we
Oh,
go.
okay.
Sorry.
Like I can
There we
see you.
go.
I can't hear you. It's nice to meet you, Jordan.
Yeah, it's nice to meet you as well. Thanks for having me. I appreciate it.
Absolutely. Super excited to get into especially financing, right? So many people are struggling with really being able to make their deals pencil out right now, and especially from the traditional institutional side. So excited to have everyone joining us. As you're joining us, welcome to today's webinar hosted by our investor community. My name is Liz. I'm one of the co-founders of our community, and just so excited to have you on today. So as I jump in, we like to start on time. We like to end on time. Please share your name in the chat box, what you're looking to get out of today. And then Jordan, I'm going to give you the floor just in a few minutes. I'm going to go through a
Yeah.
few quick slides and then we'll get going. And then I'll come back on at the end to field questions about quarter of or so, if that works.
Yeah, that's
Okay,
perfect.
awesome. Let me share my screen and we'll get, as I say, rocking and rolling here. But where are you out of, Jordan?
So right now I'm in California, but I reside in Georgia.
Okay, cool.
Yeah.
You're a lot warmer than I am. I don't know if anyone is in the East Coast, but it starts snowing today. So,
Ooh.
we got that going for us. We got that going. So let me just share my screen here. Okay, awesome. Okay, so thanks again so much for everyone being here. If you are new to our community, I always assume everyone's been with us on the journeys 5 years ago when Andres and I started the Real Estate Investor podcast, and we didn't know if this was even a needed thing where we were bringing women together and empowering them to live financially free and balanced lives. So, but if you've been with us for a while, welcome back. But if you're new to us, put that in the chat box. Welcome. I'm so excited that you're investing your time with us because we don't take that lightly, especially the holiday season. So a couple different things here I wanted to share. Many of you are part of our Facebook community. And if you are not, that is a free community where you could be asking questions, posting questions, getting the support that you need. And it's a safe place to kind of give and get support. So definitely get connected to us there. We also have meetups across the country and in Canada. And those are local groups of women just coming together to, again, give and get and learn and grow on the journey of financial freedom. So if you don't have a location in your area, definitely reach out to our team and we'd love to have you launch one, because our goal is that every single location in this world, there is an investor meetup where women get the support they need on their own terms. So we kind of eliminate that feeling of being alone. So for realtors and for real estate agents, we know it's an interesting landscape out there right now. We have an investor org, which is part of EXP, and it's really about obviously supporting women agents and growing their their business, agent business, but also on the investment side. So we kind of have a unique team where we're pulling those two pieces together. We also, like I said, do these free webinars every month. We do twice a month. And there are usually three pillars that we focus on: real estate investing, which Jordan, you're going to be diving into some financing pieces today. Business, because you can't run your real estate investing business just like as a hobby. You need to run it like a business. And then we also really talk a lot about self-care. Now, that's not the last one. It actually should be the first one. But we had a doctor on about a month ago talking about women's health and we really hold those three pillars really important. So it's not just about making money. It's about living life financially free on your own terms. And it's holistic, right? It doesn't happen just with money. For those who don't know, we have our investor con coming up June 2nd to 4th. We are so excited about we are so always excited about our conference, but it is something that many women are pumped, excited about. We have about 30 speakers coming, 40 sponsors coming. We had 500 women last year. We expect the same this year. And it's going to be in Austin. It's going to be a beautiful Omni in Austin. And it's just going to be transformational. That's the goal, is that it really brings you wherever you are walking into to the next level. So definitely check that out. Join us. Really pumped about that. And then lastly here, we have our Strive mentorship program. And I want to give a big shout out to Fatima. We have this complimentary strategic call that we're offering, no strings attached. But if you have 5 to 10 deals, if you've done 5 to 10 deals, excuse me, and you're looking to grow and you feel stuck, you feel a little stuck in the mud, you're not sure how to grow, you're doing it all yourself, you're tired of doing it all yourself, we're offering this complimentary. Fatima is one of our senior business coaches. She is amazing. I will put the link in the chat box as well. And this is the QR code, but she's offering coaching calls for free, complimentary, to help you wherever you are, wherever you want to go, and how to get there. Because it could feel really alone when you're doing this stuff by yourself. So I wanted to make sure I said that. Without further ado, Jordan, thank you so much for being here, and excited about getting into. I know you've originated like 300 loans or something crazy like that. So, I really am excited for you to talk about this very specific type of loan right now, especially in the landscape that we're dealing with, right? Interest rates being higher and inflation and a looming recession. Everyone's talking about that. Just everyone's talking about, right? They've been talking about it. So curious to get your thoughts, and then I will, not thoughts, but have you present about that, the specific Fannie Mae product that you're going to share. And then I'll jump back on to field questions about 15 minutes too. Does that work for you?
Yeah, that's perfect.
Okay, cool. Thanks again for being here.
Of course. Thank you for having me. So I'm going to get my screen set up real quick, and then I will start sharing it.
And as everyone's preparing, one thing that we do with anything we do, whether it's InvestorCon, whether it's our meetups, whether it's a free webinar, want you, as you're listening to Jordan, I want you to focus on, what is my takeaway here? What's one thing am I going to do? I'm going to ask everyone to report on that at the end, but we don't do these just because we have nothing else to do. We bring on experts to really help you move the needle, and you can't move the needle by learning only. Knowledge isn't enough. It's just not. We can learn everything we want to learn, but if you don't take action, it's like kind of like a mute point. So as you're listening and learning what Jordan's going to share, I want you to really think about for yourself, what is that one takeaway? So without further ado, thanks so much again, Jordan.
Of course. I'm going to put this back up. There we go. All right. Can everybody see? Hopefully you can see that screen. All right. All right. So, again, thank you so much for having me. I'm excited to share with all of you, making your dollar essentially go further when it comes to real estate investing. So as Liz had said, I have been, thankfully I have closed just over 300 transactions. I entered into the mortgage world back in 2019, and I did move across the country to kind of start that journey. I knew nothing about mortgages, but when I got into the industry, I saw just a reoccurring theme where clients had just a lack of education. And that was really frustrating on my end, because there were so many people that wanted to purchase a home and get into this journey, and they felt like they had nowhere to go. So because of that, I started to post online, just to try to help the general public gain some sort of knowledge when it came to, purchasing a home and getting into this world. And I realized that a lot of people learned better when it came to video, as opposed to like our traditional way of marketing. And since then, I've grown to over 250,000 followers, and I've closed just over 83 million in volume. So I've been so blessed to be in this industry and have a great community. And I really advocate for learning as much as you possibly can to better yourself and your family and your client. I'm excited to get into this. So kind of going over just a few, we'll touch on why multi-units are great investments, what does and doesn't qualify when it comes to the property itself, the differences between conventional and FHA, and then saving a deal even if the home is, let's say, run down or needs some help and it wouldn't pass a conventional appraisal. So why a multi-unit? So a flexibility on your mortgage payment. When you go into a single family home, you're the only person. I mean, unless you have a spouse or some family members living with you, at the end of the day, it's really just you that's responsible for that mortgage payment. And moving into a duplex, a triplex, a fourplex allows you the flexibility to have other individuals help pay for that mortgage and therefore accrue more equity into that property. It also allows you to ease into the investment world. So if I could do it all over again, before this product, I would have gone with a 4-unit, 3.5% down on an FHA all day. And that, I wish that I could go back a few years ago and do that and kind of restart. So it really is a great option when it comes to coming in with a lower amount of money and going into investing, because you're able to, again, live next to your tenants and see kind of what's going on. You're able to keep an eye on those tenants. And, if something goes on with a water heater or a leak or anything like that, you are able to hopefully alleviate that problem sooner rather than later. Because you're there right next door. Now, keep in mind when you are looking at this product, it is for primary residence. So you are required to live in that home for at least 1 year. After the 1 year mark, you can go ahead and move out of it and then rent out that unit that you're vacating. It's also a great alternative for multi-generational families. So as Liz was saying, the interest rates and inflation and all kinds of things, we're seeing a lot more families move in together. And this is a great way to where you're all kind of under the same roof, but you have a lot of walls separating you. So it feels a little bit more spacious, and you have a bit more privacy. So this is a great option for that as well. Again, it makes your dollar go further because prior to this, you really could only go with a government loan to get a multi-unit home. If you went with a route, you would have to put 15 or 20 or 25% down. So now this option has rolled out, just came out last month, where we could start originating with it. And now you get to put 5% down, which is amazing. And it also allows you to have a loan amount just shy of 1.5 million. And I'll touch on this a little bit more, depending on where you live in the US. And when it comes to the property itself, there are some things you want to think about when it comes to what qualifies and what doesn't qualify. So if the home was converted into a multi-unit home, or multi-unit property, I should say, we have to make sure there were permits taken out, because if there were not permits taken out with the county, unfortunately, it will not work. So that is a big, big item. We have to make sure that the home fits within. ADUs are also not permitted. So if you're not familiar with an ADU, it's an additional dwelling unit. So generally, it's a big thing out in California, where they'll take like the garage and convert it into an ADU to where, has a bathroom, a kitchen, a living space. It has heating and cooling units in there, but ADUs are not permitted. Properties that have multiple utility meters. So for instance, if you're looking at a home and it's a duplex, each side should have a utility meter. So all of the utilities should be separate. We have to make sure that it conforms to legal zoning. So again, this goes back to if it was converted as well, from a single family to a multi-unit home, we have to make sure it's zoned correctly. Some types of properties that won't work are going to be farms, ranches, or unfortunately, those are just not something that Fannie Mae is willing to underwrite, so we could not qualify them as a multi-unit home. And then properties also located on Native American land are not going to be possible, again, through Fannie Mae. And again, like I had mentioned, prior to this, you could look at a government loan. The main one most people looked for and qualified for was an FHA loan. And the reason why is just because of their credit score requirements weren't as strict. Their debt to income limits were a lot more lenient. And so now when we look at the two, we have to figure out which one is going to make the most sense. And each person's situation is different. I go back and forth with a lot of my borrowers that qualify for both, and we have to look at kind of just specific to them what their needs are and what they want to do with that home to figure out which one is going to make more sense down the road. But just to give you a few ideas as to the differences, we'll look at the first one, which is the self-sufficiency rule. So this applies on FHA loans, not for a duplex. So if you're looking solely at a duplex, this does not apply to you. But on a 3 to 4 unit home, we have to work with the self-sufficiency rule. And the self-sufficiency rule is essentially when the income from the rental income from the units has to exceed the monthly mortgage payment. And so I'll just give you an example here, and I'll come back. But for instance, let's say that there was a 4-unit home and the market rent estimate for all 4 units was $4,000. Now, the general rule of thumb when it comes to the vacancy factor is 25%. So that is a standard rule across the board. That's what we use. We will look at what the appraiser states. If the appraiser states anything less, we use the 25%. If they state more, then we have to go, essentially we go off the greater of. So 25%, again, is that general rule of thumb. Therefore, we would have the $3,000, and they're stating in this example that the principal, interest, mortgage insurance, taxes, homeowners insurance, and HOA dues would equal $2,900. Therefore, this home would work because the $3,000 a month rental income would exceed what the mortgage payment would be. So do keep this in mind when we are considering your payment, whether we're looking at the self-sufficiency rule or just in general, what we have to qualify you. Even though your HOA dues are not paid as part of your mortgage, we do have to make sure you qualify with them. So just kind of keep that in the back of your mind if you are looking in any sort of neighborhoods that carry an HOA. And then I'll go back to this slide. So conventional does not have that rule. They do not have the self-sufficiency rule, which is a big game changer. That's going to probably be the biggest difference between FHA and conventional, because we run into that. For instance, if you're looking in California, depending on where, but most of California, yes, the home prices are more, but the rent is very, very high. So you will probably reach the self-sufficiency rule in a place like California. Whereas if you're looking maybe in like middle of America, depending on, again, the price of the home and what that rent goes out for or goes for, you may not meet it. So we don't have to worry about that when it comes to the conventional loan. We also look at PMI and MIP. So if you're not familiar with the two, there is a difference. Most people just think there's PMI, and PMI stands for private mortgage insurance, which is tied to conventional loans. Conventional loans are not a government loan, and therefore they allow us to use private mortgage insurance. And essentially what it means is us as a lender, we work with different mortgage insurance companies. I believe we have like 6 or 7 with our company, and we will put the quote through, or sorry, we'll put the request through, and the different quotes will come back. And things like your credit score, how much you're putting down, your debt to income, all of those variables will come into play. when it comes to what the mortgage insurance premium has to be. And so for conventional, it could be really high, it could be really low. It can vary quite a bit depending on how much of a risk you are. Whereas when you look at MIP, which is mortgage insurance premium, they do exactly the same. That is tied to an FHA loan. So FHA, again, is a government loan. They have a flat fee. It's 0.55%. If you put a little bit more money down, they will have it lowered to 0.5%, but that's standard. And it doesn't matter your credit score, your debt to income, it is a flat fee. So depending on where you fall, better to go with an FHA, better the conventional. And another thing to keep in mind, with which a lot of people don't realize, is that with a conventional loan, the mortgage insurance eventually fall off. Now, whether that means you request for it to fall off because you've accrued some more equity, or that, whereas an FHA loan, unless you put 10% or more down, that mortgage insurance will stay on for the life of the loan. You can always refinance the loan into a conventional to get it removed, but if you're staying with an FHA, it will be on there for the life of the loan with less than 10% down. So that could be a really big factor for you when it comes to deciding. And then credit score. So credit score, that's going to be a difference of a 620 for a conventional and a 580 for an FHA. I will say, if you're looking at going with a multi-unit home, you are going to need, more than likely, unless you have a huge down payment, you're going to need a higher score. So what we've been seeing, at least me, for the files I've had to come through, when it comes to multifamily, normally I would say 680 or higher, you have a pretty good shot. When it comes to conventional, when it comes to an FHA, normally 640 is where we'll see that sweet spot where, multi-units, sometimes 620. So it just really depends on your debt to income ratios as well, which brings me to my next item, which is your debt to income. So DTI stands for your debt to income, which is always done in the mortgage world on a monthly basis. So we will look, we don't care that you carry a $30,000 car loan, we care that the payment's $650. Just like your income, everything is done on a gross basis because everyone across the US needs to be on an even playing field. So if you make $60,000 a year, that's $5,000 a month that we go off of, not what you net at the end of the day. So your debt to income, much more lenient with FHA, like I had mentioned, as opposed to conventional. Conventional lets you go up to 50%, whereas FHA lets you go up to 57%. So there is a bit of a difference there, and that's your total debt. So that is all of the debt you carry on your credit, if there's any alimony, child support, back taxes that are owed, and then obviously the new mortgage you're trying to take out. And then there is a difference, again, in the loan amounts. Generally, conventional falls on the higher end as opposed to FHA, which I will get into on this slide. So there are different loan limits, and these are going to be for 2024. So if you are looking for conventional, we can start writing conventional now, even though we're not quite in 2024. Again, it's a non-government loan, so sometimes they're a bit more lenient. So to keep this in mind, this is going to be for most of the US. So it will be a 2-unit, a 3-unit, and a 4-unit home. Now, if you're in an area like Alaska, Guam, Hawaii, or the US Virgin Islands, that number goes up quite a bit just because of the cost of living is so much higher there. So keep that in mind, that depending on where you are in the US, your loan limit will fluctuate. Now, there are a few areas in the US that are considered what's called a high cost area. And just to give you some examples of what a high cost area, there are places in California, New Jersey, Colorado. There are some counties in Florida as well. They're kind of trickled out throughout the US where they're considered, a high cost area. And when that happens, we look at higher loan limits. And these higher loan limits will coincide with Alaska, Guam, Hawaii, and the U.S. Virgin Islands. And so if you're looking to see kind of where your loan limits sit, you're able to go to Fannie Mae's website, and they will have their calculator, and you can put where it is that you're purchasing. Normally they let you go by the state and the county, and then they'll tell you what each, 1, 2, 3, and 4 unit property loan limits are. And remember, this is for your loan limit, not your purchase price. So if you are looking to put 5% down, this is going to be a little bit lower than what your true purchase price will be at the end of the day. And when it comes to FHA, as you can see, this is for 2024. So keep in mind, for FHA, we can't do a true application and order the FHA case number until January 1 of 2024. So you couldn't technically go under contract right now with these loan limits. We would have to go off of 2023 limits if you decided to try to make this month. But 1, 2, 3, and 4 units. So as you can see, these are a bit lower than what the conventional ones were. The rule of thumb is that they're 65% of the conventional loan limits. Now, the difference is outside of the high cost areas will always match. They will always be the same, just as a heads up. But when it comes to Alaska, Hawaii, those additional states, or areas, I should say, those jump up so much more. So keep this in mind, that if you are looking in one of these areas, depending on the purchase price amount, you may have to go with an FHA loan as opposed to a conventional, just due to the sheer difference. I mean, look at a 4 unit is 2.2 million on conventional, where it's 3.3 million, which is a huge difference for FHA. So just something to keep in mind, depending on, again, where you're looking in the U.S. And then another thing I wanted to touch on is renovation loans. So we do renovation loans. A lot of lenders will do renovation loans. And most people think that when it comes to renovation, like this is what the house is going to be looking like. You're going to have to tear it completely, gut the entire thing. And that's not necessarily the case. We've saved a ton of deals that were both FHA and conventional that didn't pass inspection and appraisals, to where we needed to we needed to replace the roof, and there were different utilities that needed to be replaced, and maybe some big ticket items that they were willing to take on, but they just personally couldn't come out of pocket with those. So this is a great item to keep kind of in your back pocket if you ever come across a home that doesn't meet those minimum requirements and you don't want the deal to essentially be dead and you want to try to save it. This would be a great option to keep in mind. But when it comes to a multi-unit home, and this is again for conventional, because that's kind of our main focus for this call, these are some things you're going to want to keep in mind. So the credit score is still a minimum of a 620. We cannot look at, unfortunately, high balance loans. So high balance loans were these high cost areas. So we couldn't look at doing a renovation loan if you did sit in one of those high cost areas. And again, if you're not familiar what your area sits within, whether it's a baseline or a high cost, Fannie Mae's website, you can look directly on there. So if you are, unfortunately, that's not something that they'll cover. When it comes to the loan amount, so the minimum loan amount is going to be $50,000 with the maximum loan amount based on your county loan limits. So this would work if you already own a multi-unit home and maybe the mortgage is paid off, you inherit a home, something along those lines, and maybe you want to convert it from to a large enough space where you want to convert it from a single family home over to a duplex. As long as the loan amount is at least $50,000, this is something that you could look at doing. And again, maximum per the county loan limits, as long as you're on the baseline. So this is a great option. Again, if you're just trying to do maybe the roof and the AC, there's water heater, there's new carpet, there's cosmetic things like that, like paint, and wanting to do a bathroom renovation. So it's really a great there when it comes to the terms. There's both fixed and ARM options that we could look at. Unfortunately, you cannot waive escrow on this type of loan when you go with a renovation. So escrow, if you're not familiar, that covers your property taxes and your homeowner's insurance, as well as your mortgage insurance if it's required. So that's not something that you're able to waive when it comes to the renovation loan. And what we do is we pool a small chunk of funds into the closing cost at closing to make sure that we have at least a little cushion in there to start your escrow account so that we are ready to go for when you start making your mortgage payments, and therefore when they are due, let's say at the end of the year, or whenever they are due. Do keep in mind that the units have to be attached. So this is a big item that you may not think of. When it comes to a non-renovation loan, not a big deal. I have one right now where the borrower, there's 2 separate buildings on the property. They're zoned, permits, everything like that is good. But the first home is a single family home. And then the, home or building behind it is actually a duplex. So that would be then considered a 3-unit property. And that's fine if you're looking at maybe going the traditional route, but when it comes to renovation, it all has to be under one roof. This is probably the biggest one at the end that I run into when it comes to borrowers wanting to use their uncle or their cousin, or maybe they even want to do the work themselves. The contractor cannot have any sort of interest in the transaction. So it couldn't be like my husband doing the work because I'm the loan officer. It couldn't be the agent's brother because they would be, that's an identity of interest. So making sure that we get a licensed contract, very important, but they can't have any sort of interest in the transaction at all. And then when it comes to any sort of like self-work, it's technically not allowed. So because what we get is the bid from the contractor, and that bid includes, the work that they are going to be doing for their labor and the supplies and everything like that. And they can't just add onto the bill or the work number, John Smith wants to also just paint the walls himself. That's not something that's possible. So kind of keep that in mind when it comes to looking at maybe a renovation loan. And then just to kind of go over some statistics. So this is volume of multifamily dwellings in the US. And I went back to 2019, and these numbers are in the millions. So in 2019, which was for almost 5 years ago, we were looking at, which is crazy for me to say almost 5 years ago, it feels like just yesterday, 68, just shy of 69 million units, dwellings. That's crazy. And then when we look at 2023, and obviously we're not finished quite with the year, so this is what was projected earlier this year to be completed, but we are looking at 155 million dwellings. So as you can see, it has grown year over year. I mean, even when we look at, the COVID years, it still grew year over year. So multifamily dwellings are very much a thing that are in demand, and they are out there. They are building them. Multifamily homes don't cost quite as much as single family homes, depending on where in the US you're looking. But for the most part, multifamily homes generally don't cost more than a single family home. So kind of keep that in mind when it comes to looking at these, because we are very much growing for multifamilies, and it has over doubled in the last 4 years. And I'm excited to see what 2024 projections come out to be, because I can only imagine that it's probably going to be in the high 100 million, probably, I don't think it'll be all the way to 2, maybe like I'd say probably like 175 to 190 is probably where it'll be. If it gets to 200 million, I would be surprised, but not crazy surprised, but I could definitely see that may happen. So with that being said, I am happy to answer any questions, whether it's you're looking to, get into investing on your own, or maybe you have a client that maybe has some questions or is thinking about it, whether you've already owned, you haven't owned quite yet, and this is kind of that first step you're looking to take. I'm more than happy to answer anything that I can.
Awesome. Yeah. If I can encourage everyone to post any questions that you have for Jordan in the Q&A box, that would be great. Instead of the webinar chat, because it just tends to get busy there. So yeah, let's field a few questions. And again, I want to encourage you, if you're not someone who normally asks questions, to ask a question, because we're doing this live, right? This is not a pre-recorded event that Jordan and I are, just sharing. We're doing this live so we can best support the community with questions in real time. So I encourage you, if you're someone who doesn't want to like take up space, or I feel bad, ask away, get what you need. That's what we stand for the community we have. So I just wanted to share that. All right, I put my glasses on here because, getting older and I can't see. But anyway, Felicia, how does the owner occupied unit factor into self-sufficient? I guess that's something you mentioned.
Yeah, so owner occupied, so it's not considered your unit is not part of the equation. So let's say you buy a fourplex, we are looking at the other 3 units that are in play, because this works for 3 to 4 units, that self-sufficiency rule. So something to consider, whether you're an agent or you're not an agent, you're trying to look at going into this world, I highly, highly suggest making sure you get an agent that knows at least a good amount on how to run comps appropriately for multi-unit homes and the rental market in that area. Because as a lender, we take that into consideration when trying to qualify you, because I don't have the ability, I don't have a license to go into the MLS and run those back end comps. And so if you and I are just sitting here trying to figure out how much the other 3 units in your property are going to rent for, we may fall short on it. So making sure you have an agent that knows what those numbers look like and how they can best help you. So we have at least something to kind of go off of until the appraiser comes back and lets us know truly what that amount will be.
Okay. Awesome. Yeah, appreciate that. Cindy. Hey, Cindy. I know you, Cindy. Hope you're well. What do these numbers represent exactly? Number of units completed. She might have been referring to something in about a middle of your presentation. That's going to be hard to figure out because it says, what do these numbers represent exactly? So, Cindy, if you can be more clear, if you can put in the Q&A box what you were referring to, that might be helpful, because let me see here. Oh, Cindy. Okay. No, I saw you ask another question. I'm gonna answer your other question. Does the borrower have to be an individual, or can an entity like an LLC qualify?
So it does have to be an individual. I've had though where there are, multiple people that are on the loan. And then what I've also had people do is, after closing, they have asked the title company to look at, we can't close in an LLC, not for this type of loan, not through conventional. We can for non-traditional loans. But if you're looking to maybe put the property into an LLC, that is something you could talk to the attorney or the title company after we close to figure out what paperwork they need to file for you.
Yeah, that's important. Nell, nice to see you, Nell. You're one of our Strive members, so thanks for being here. You're asking, are there creative ways around the residence requirement?
The residency of the 1 year is probably what they're referring
Referring
to.
to.
So,
Yeah.
um, so technically you sign off on the paperwork. It does say that you will occupy that home for 12 months. So you are responsible, things like setting up your utilities, and having them in your name for that specific unit. That's a way for them to make sure that you are still living in that property as your primary residence. I can't say that people are going by, Fannie Mae's walking and knocking on your door, making sure that you live there, but things like public records and where your mailing address is, things like that will show that that is your primary residence. So there's not necessarily a quote unquote way around it. The only time I've ever had somebody move out of a home prior to the year mark was when there was a family. So they ended up getting pregnant. And so we had something to fall back on where it was like, this wasn't, this was not the plan, but we are here. And now this half of a duplex, unfortunately, doesn't work for us. So we do need to move into a new home. So that was a way that we kind of, I guess, worked around the residency.
Awesome. Yeah, then that makes sense. And real quick, I've gotten a couple questions about replay in terms of the recording and all that good stuff of today's webinar. All of our recordings within 24 hours to 48 hours are on our blog page. So you can even check out the most recent webinar, all of our podcasts, all of our kind of material there in terms of content is all there on that same page. So keep an eye out. This should be posted fairly soon. So I just want to mention that I put the link in the chat box. All right. Can you put 5% down on a multifamily if you already co-own one primary residence with your spouse?
Yeah. So when we have people moving from one property to another, that's totally fine. Because you would be occupying this home as your primary. So that is the rule. So yes, you can. What happens whether you own one, you own multiple properties, the home that you are vacating in this scenario, we have out whether or not we can quote unquote use rental income to offset that mortgage, or if there's not a mortgage, the expenses, because even if you don't carry a mortgage on a home that you own, taxes and insurance and HOA dues are accounted for as part of your debt, just to kind of keep that in mind. But when moving into a new home and wanting to keep one, we have to figure out if we can get rental income to offset that mortgage, because otherwise we would have to hit you with the full mortgage, or again, taxes, insurance, and HOA dues on a monthly basis, which may disqualify you from the new home. So it is possible. But if you're on there, we just got to figure out if we can, and then how much rental income we can use for that vacating home.
Makes sense.
Yeah, you
Okay.
do not have to be a first-time home buyer for this property, for this type of loan. It's not required, both FHA or conventional. They do not require you to be a first-time home buyer.
Cool. That's very helpful. Can you confirm indeed that owner has to occupy one of the units? I think Flores is asking.
100%. Yes, this is this is to help the people like us. This is not to help the big, huge companies that are out there that have the funds to put 15 to 25% down. This is to help the families and the individuals that want to help start their investment portfolio, just like FHA did. So yes, it is meant for primary residents. You cannot buy this as an investment home solely. You can turn it into a full investment property after the 1 year mark, but when we close on that property, you do sign off that you will be moving into it within 60 days and you will occupy it for 12 months. Yeah.
So important. And we take for granted that everyone knows what house hacking is, but there might be people on this webinar that aren't familiar with house hacking. And it's a wonderful strategy, especially with a program like this, where you're in essence, right, living in one unit and renting out the other. So it's a really powerful, not only financing strategy, but way to get going with the investment. And then you move out with, obviously in a specific time frame. But we take for granted that everyone knows what house hacking is, but if you don't, it is just tons of information on strategy. And then obviously the financing piece, like Jordan is speaking about. All right.
Yeah.
Agnes, credit score of 850. Awesome, Agnes. Very cool.
Yeah, that's fantastic.
So first celebrate that. No active income. How does passive income get included? Examples, interest income, distributions, and dividends.
Yeah, so I've worked with tons of people that don't necessarily have a W-2 job. So whether it's disability, it's dividends, depending on kind of where those funds come from, um, and how long. A lot of times we'll have to show a history of you receiving it. Um, so for example, like a 2-year history, a lot of times we have to make sure that it will also continue for at least 3 years from the date that we close on the home. And this applies for things like alimony and child support, as well, disability, Social Security, VA benefits, anything like that, dividends. So we do have to make sure that for most non self-employed and non W-2 income, we have to show a history and for sure have to show a continuance, because we have to, I know it's not guaranteed, but we have to show that there's some sort of, backing that you will be keeping this income.
Very cool. And Donna, yeah, Willow recording. I shared that a little bit ago, but yes, go to the blog page. I literally just put the link in the chat box. That will be available within a couple of days, and the recording will be there, plus all of our recordings of all of our free webinars. So you can really learn a lot of great info from some great speakers. Hey, good to see you here. When purchasing multi-unit home, does at least one, okay, we need to be, does one unit need to be vacant or can be fully occupied and we can ask one unit to move out after purchasing it?
Oh, I see. Okay. So if the home is fully occupied, so let's say you are purchasing a duplex and both sides are occupied, then again, you're signing off that you will be moving into that home within 60 days. So we have to make sure that you can fulfill that. So a lot of times, if there are already tenants in there, the current seller will provide the lease agreements that are attached to said property to show that their lease is ending, so that we can back the fact that you would be moving into it. So whether there are people in it or not, that's not a big concern. It's just rather, if there is people, that they will be out within that 60 days so you can move in. And if there's not, that's okay, because again, we use the appraiser's comps based on the area to figure out what the income will be, the rental income will be for said unit or units attached to the one that you're living in.
Makes sense. All right. Diddy, if we have a 2-family investment, can using it as collateral help with the not so shiny credit score? Interesting question.
So they're saying if they already have one?
Yeah, if we have a 2-family investment property ready, can using it as collateral help with the not so shiny, so probably not as high of a credit score?
With that, generally not. I mean, unless it's like owned outright, even then it's considered, there's the liability of the taxes and the insurance and things like that. So conventional doesn't take that sort of into consideration as using it kind of like as collateral, unfortunately. So we could always look at, how can we up your credit? Is there any way, is there any little bits that we can kind of tweak or adjust? Because you'd be surprised how many people I talk to, and it's like a very small amount that we need to do to really bump their scores up quite a bit.
Well, that's cool. So that's a really good question, that you guys will then do that, where you'll work with them to help them increase their, okay. That's great.
Oh yeah, 100%.
That's great to know.
Whether it's like myself or even we have, it's called Road to Home, and it's our internal, we don't call it credit repair because we personally aren't doing the work for you. We are giving you everything to do and showing you and telling you how to do it. So we call it like our credit enhancement program. It's
great.
Free. But yeah.
That's huge. And I think that's a huge benefit, because credit is doable. Getting it, it just has to be very strategic, right? And you have to do it consistently and all those important things. So don't give up if your credit's not as strong. Okay. Anya, you're asking how to how to locate bank. Oh, how to locate banks that will loan under 50K. Hmm.
Ooh, if you're trying to go under 50K, I would probably suggest calling a local credit union. Generally, local small credit unions tend to have a little bit more leniency on their guidelines because sometimes they'll house the loans themselves. They won't sell them off to like Fannie Mae or FHA. So you may get a little bit further with some place like that. Otherwise, you may have to go like the hard money route, like a hard money loan, which with that, your interest rate's probably going to be quite high. You may have to put a good chunk of money down for them to lend on such a small amount.
Yeah. Good point. And I think it's always, I just mentioned this, it's always really great, especially now, even if you don't have a deal or if you have a project that's like a sample project, like something that you really want to do, like a 4 unit, start calling banks, local banks to see what their appetite is. You don't need to have a property under contract. That's not when you want to call banks. You want to call them and have calls like with Jordan and really get clear on your game plan, so you know your options once you get a project under contract. It's too late at that point. So if you don't have a property under contract right now, this is a perfect time. Start getting your ducks in a row. Start building the relationship. Start calling those local banks, having conversations with Jordan, looking at your credit score. That's the work to be done right now. Do not get discouraged by what everyone's saying in the news and interest rates being higher and it's not a good time to find a property. And listen, it's always a good time to buy. You have to be conservative right now and be smart. However, get your ducks in a row. And that's the work, especially around the holidays. No one's doing that, right? Everyone's in la land. This is the right time to get your ducks in a row. And people are going to, they're going to pick up their phones because they're just not they're busy. So keep that in mind. I think phenomenal deals can be done right now, literally now until the end of the year, because people are distracted and opportunities are abound. So I just want to say that, especially from a lender bank relationship perspective. And even if they're busy, you try to get in front of them. So I don't know if you have any thoughts there, Jordan, but I feel like people kind of go like little like silent right now because they just check out, but this is the time to not check out actually.
Yeah, in general, winter months are the best time on the buyer side of a transaction because we have the holidays and
Yeah.
people are taking vacations and they have family obligations and they're spending money on gifts and they're not worrying about moving. So it is a great time in general, to purchase. Again, if you are smart about it and financially you feel comfortable with the payment
Yep.
and the money you're putting out there. But I mean, I have so many deals right now that we have one that they're getting $25,000 in seller concessions
Yeah.
on a $450,000 home. I mean, like that's not a normal thing,
Yep.
especially if you were in the market in like 2020 and 2021, and that
Correct.
won't be normal next year because the rates are projected to go down. You won't get that. So if you
Yep.
are a little bit money strapped, for you have your down payment but maybe you don't have your closing costs, it's still worth talking to a good lender and a good agent that's going to team up and help you, because you'd be surprised how many people are like, I need to get out of this house. Like there was a death, there was a birth, there was a promotion, whatever. Everyone has a different life situation going on. And sometimes they just have to get out from underneath that house, and they would be willing to like move heaven and earth to make that deal happen. So
Yeah.
just
Yeah.
don't be discouraged if you don't have all of the money. Talk to the lender before you get there, because they may have strategies to help you get those last few $1,000s, let's say.
I love that. And sometimes it's strategy and sometimes it's like tactics and sometimes it's our mindset, right? Because it could be both. And what limits us could be I just don't know what loan products I can get right now. And it could be I'm holding myself back. So I want to put that link before we go. I want to do 2 more quick questions and we'll rock and roll. But I want to put that link again for our free complimentary call with our senior business coach, Fatima. She's amazing. And I know for the women they have 5 to 10 deals, but they want to grow. She's been really, really powerfully helping with that. No strings attached, just a complimentary coaching call. All right, Hillary, you got an interesting question here. I have a high DTI because of a high 15-year conventional loan on my primary. Interested in renting out my primary and house hacking a fourplex. How can this work regarding qualifying for a new mortgage?
Yeah, so what we would do is we
Oh,
would
really
go
quick,
ahead.
Jordan. People are asking where they can find you. Can you put that in on a slide? Because that's
There,
important. Okay,
there
awesome.
we go.
I don't want people to jump off too quick without connecting with you.
Yeah, there we go.
Yeah, if you don't mind, we can get that question
Sure.
answered, and we'll rock and roll. Thank you.
Yeah. So when it comes to the home that you're vacating, so we talked about how we would go ahead and figure out the new rental income for the home we're trying to purchase. But the home you're vacating, you would need to get an executed lease agreement. Now, this doesn't mean, okay, I'm going to close today, which is December 7th, and the lease has to happen. It can happen, there's some leeway with that. But you would have to get an executed lease, not before you talk to the lender, just in general, we'd have to get that. The security deposit has to be cleared in your account. And then what we do is we have, you can't order this because they look at it as if you're trying to fudge the numbers potentially. So it has to come from unbiased. We would order it on your behalf to have an appraiser look at. Most of the time they don't have to go into the home. They can just run it on their computer, comps in the area to make sure that the lease agreement coincides, or the lease amount, I should say, coincides with what's going on in the market. Because if you just get your best friend to write a $3,000 a month lease, but the rental income's only $1,200 in that area, that's unfortunately not going to work out. So what we do is we take that, let's say it's $1,000. We use 75% of it. That's again, that's a standard across the board. So we would use $750 to offset your mortgage. Now, if the mortgage, which includes your taxes, insurance, mortgage insurance, HOA, all of that, if that is less than $750 in this scenario, so let's say it's 600, I can't use additional income. So I can only use enough of the rental income to offset it. You don't get extra like overage. But let's say your mortgage was $1,000 and we have that 750, I only have to hit you with a $250 a month deficit. So that's just the difference.
No, it makes a lot of sense. And there's a lot of details to these arrangements. So make sure you're getting solid advice from the right people. I think that's also part of this. That's why we
Oh,
work
yeah.
really hard at getting great people like Jordan on, so they can teach and share and come from a place of giving versus what's out there. So Jordan, thank you so much again for your wisdom and you kind of sharing these products with the community. Thank you everyone for being on. As we're ending in these last 2 minutes, my request is in the chat box, put your takeaway, put your one action step that you're going to do as a result of today. I would never be on a webinar where I cannot connect with an action I'm going to take, because then this just was a nice hour of your time that didn't do anything for you. And that's quite honestly not what we do here at the investor community. Knowledge is not enough. It's just not. It's about the community. It's about getting involved. It's about taking action and supporting each other in the process. That's why we have a community we're building. So, all right, some action steps. I love action steps. It gives me such a dopamine hit when I see action steps from people. Form relationships with local banks. Very cool. Daniel tried to find a quad. Okay, awesome. Dolores, go find that 1 to 4 multifamily. Build my savings. Very cool, Tamika. That's a great step. I'm going to start calling lenders. Great. Very cool. Talk to a bank. All right, awesome. Connect with that local bank. And please use our Facebook community. That's where you can post like, hey, or our meetups. I'm in this area. What local banks do you work with that are investing here? Don't reinvent the wheel, right? Use the community, lean into the community to get your answers as well. Thanks again so much, Jordan, for being on. I hope you guys connect with her and appreciate everyone's time today. So, and then just a really quick announcement. Next Thursday is our next webinar. So check out all of our events at therealestateinvestor.com/events for all of our upcoming webinars. So thanks again, Jordan, for being on. And thank you everyone for joining us.
Yeah. I look forward to the next one. Thanks.
And do
Bye-bye.
your action step. Take care, everybody.